Hello and welcome to Virtual Investor Conferences. My name is Eric May, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Pacific Financial Corp. Before we introduce our speakers, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with Pacific Financial, please click on the Meetings tab found in the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Denise Portman, President and CEO, and Carla Tucker, Executive Vice President and CFO of Pacific Financial, which trades on the OTCQX Best Market under the symbol PFLC. Welcome, Denise and Carla.
Thank you. Thank you. It's our pleasure to present today. My name is Denise Portman, and with me, as introduced, is CFO Carla Tucker, and we appreciate those of you joining us for this virtual investor conference. Before I get started, I want to direct your attention to our forward-looking statement disclosure. This presentation contains forward-looking statements that are subject to risks and uncertainties. We undertake no obligation to update those forward-looking statements. Pacific Financial is a one-bank holding company for Bank of the Pacific. We operate several offices in Washington and Oregon, which even in the current environment remains one of the top regional economies in the U.S. Our franchise includes a strong balance sheet heralded by an exceptional core deposit base, a low cost of funds, and a diversified loan portfolio. We have a sustained track record of delivering solid returns to our shareholders, and additionally, we have prudently managed the balance sheet, resulting in top-tier credit quality, strong capital, abundant liquidity, which will allow us to serve our current and prospective customers for years to come. Our management team is made up of 5 seasoned banking executives with many years of commercial banking experience in the Northwest. I'm not going to go through all of their information. It's there on the slides for you to review at a later time. This next slide shows the history of our company, which has been in operation for over 50 years. It includes 2 whole bank acquisitions, one in 1999 and another in 2004. Additionally, we completed a branch acquisition in 2013, and we have since opened 2 loan production offices in larger metro areas in Vancouver, Washington, and in Salem in 2013 and 2015, respectively. Today, here's a map of where all of our locations are located in Washington and Oregon. We have 16 branches and 6 commercial banking centers throughout our footprint. As you can see, we operate in 3 very distinct market areas. The first being Northwest Washington, that's up in the northern part of Washington State. Another market area that has a lot of commonality is the coastal Washington and Oregon, and that's where the bank was initially founded, was out there in the coastal markets. And then we have Vancouver to Salem, including the greater Portland area. Approximately 2/3 of our deposits are located in that coastal market where the bank was first started, whereas our loan balances are more evenly distributed between all 3 regions, with the highest growth opportunities really coming in the newer part of our footprint, which is that Vancouver to Salem. Vancouver is exhibiting solid signs of economic growth, and Salem, being the capital city of Oregon, is a very stable economic market. This next slide highlights our 4th quarter, most recent quarterly earnings, and Q4 2022 finished with record quarterly profits of $4.7 million, representing 45 cents earnings per share. And that was largely due to the expanding net interest margin, which expanded by 70 basis points, influenced by the Federal Reserve increasing the Fed funds target rate at the fastest pace in nearly 40 years. Gross loans also grew at an annualized pace of 12% in the 4th quarter. And based on these results, the company paid a quarterly cash dividend of 13 cents a share. That was payable to shareholders in Q1 of 2023. As of year end, and we're going to talk a little bit more about this later, but as of year end, 71% of our deposit balances were either FDIC insured or collateralized, and 64% of our deposits were backed by cash and unpledged available for sale securities and other off-balance sheet liquidity sources. As I indicated, we'll talk more about that in some later slides. For the year 2022, the bank finished with total assets of 1.3 billion as of year end. Net income for the year was 11 million, representing a return on average assets of 82 basis points and a return on average equity of 10%. Deposits increased slightly. They were relatively stable year over year, whereas many of our peers were starting to see deposit outflows going back to the second quarter of last year. We have a lot of seasonality in our deposits, so while they peaked in third quarter, we still finished the year on an increased year over year basis for total deposits. Commercial loan origination for the year totaled over 150 million, which was the highest we've seen since 2016. Loan balances, so while originations were high, loan balances on the actual balance sheet in terms of outstanding were partially offset by elevated payoffs that occurred early in the year, but we saw payoffs really abate in the second half of 2022, contributing to that 12% annualized growth in the fourth quarter. The next few slides really kind of dive a bit deeper into some of the numbers I just previously mentioned here, and including some 5-year trends. As you can see, the bank has a strong history of delivering sustained returns to our shareholders. The decline in year-to-date earnings for 2022 is mostly due to slowing mortgage revenue from the increased mortgage rates and a low interest rate environment in the first half of the year. On the next slide, you can see the composition of our earning assets, with loans making up approximately 50%, investments representing 22%, and cash totaling 28% of our total earning assets. Our net interest margin, or our NIM, improved substantially by year end to 4.12%, driven mostly from the immediate repricing of the cash portion of our balance sheet. Our investment portfolio is made up of high-grade treasury and agency bonds, mortgage-backed securities, and municipal bonds. With the significant increase in deposit balances, the bank did deploy some excess liquidity from cash into the investment portfolio beginning in 2021. However, given the short-term nature of our portfolio, we had capacity to add securities with a blended maturity in that 3 to 5 year time frame to increase the yield over the cash balances while keeping the overall duration under 5 years. As of year end, the duration in the portfolio was 4.9, with cash balances still remaining on the balance sheet, making up almost a third of our balance sheet. Gross loans totaled 641 million at 12/31/22. Our commercial loan utilization is still below pre-pandemic levels, providing for upside growth opportunities in 2023. Additionally, the commercial real estate portfolio is well diversified both geographically throughout our footprint, as well as by collateral type. And as evidenced in the graph on the bottom right, loan growth was mostly in CRE, construction, some consumer and residential real estate, which was offset by the PPP loan forgiveness that happened towards the beginning of the year. So you can see that makes up the change in the portfolio throughout the year. Here you can see the segmentation of the entire loan portfolio. Commercial and owner-occupied commercial real estate combined make up 36% of the portfolio. Non-owner occupied CRE totals 24. And then we have residential, both multifamily and single family 1 to 4 combined make up roughly 19%. Of the portfolio on the right, you can see 40% is variable, with another 39%. So almost 80% of our portfolio is either variable repricing at some interval. 39% of that reprices in the next 3 months. And then the remaining portion is fixed, which in the current interest rate environment, it positions the bank for strong earnings performance as we're still in this kind of higher interest rate environment. The loans that are variable in the portfolio have all moved through their rate floors at this point. So they would all reset at whatever their next repricing interval is. The next slide shows the quarterly trends for the commercial production and line utilization. Also to the right there, you can see the weighted average rate for new loan production. And due to the bank maintains disciplined pricing throughout the year, as well as spreads. And so fourth quarter, you could see with rising rate environment that the weighted average rate on new loan production was over 6% at 6.32% for Q4. The bank has excellent loan quality. Non-performing assets are well below industry norms at just 0.07% of total assets. Also, the allowance, the reserves for loan losses are strong at 1.3% of total loans. Charge-offs have been very minimal for the last 5 years. Past due loans, which are also an early indicator of potential problem loans, were minimal as of year end. The hallmark of our franchise really is our attractive low-cost deposit base. Core deposits make up 96% of our total deposits, and we have a non-interest-bearing portion represents 43% of the total deposit base, which helps contribute to a low cost of funds. For last year, the cost of funds was 10 basis points at year end. We do anticipate deposit costs to increase in 2023. However, the large non-interest-bearing portion will provide ability for us to keep overall total cost of deposits low and below that of our peers. And given recent events, I'm going to spend a few minutes here reviewing our liquidity. The chart on the left indicates that over 70% of our deposits are either FDIC insured or collateralized public funds. Further, the bank has cash and unpledged securities totaling $436 million, and that exceeds our entire uninsured deposit balances. It's roughly 1.3 times that of our uninsured portion. And in addition to that on-balance sheet liquidity that you could see there, the bank has fully secured lines of credit in place and available to us today, making up 21% of total deposits, or another $250 million. Management really has been prudent about the way they manage the balance sheet, our liquidity sources, and our funding mix in this interest rate environment to position the bank well from an asset liability perspective. We are well capitalized in all regulatory capital ratios. PFLC is managing to a prudent but optimized level of capital. We have not diluted shareholders through excessive capital raises. And we are returning capital actively and prudently through dividends, or in the early parts of 2022 also included stock buybacks. And while tangible common equity has been negatively impacted from the unrealized loss on a portion of our investment portfolio, our TCE ratio near 7% is deemed appropriate given the risk profile of the bank and the conservative and well-diversified nature of the loan portfolio. We will continue to be good stewards of our bank's capital. Looking forward, our strategic priority in 2023 is to continue to grow loans and invest in technologies that connect our employees to our customers, and leveraging our asset size and infrastructure to achieve size and scale. This includes continuing to expand our digital capabilities and further exploration of automation tools. In 2022, the bank introduced robotic process automation, or RPA, and we believe we have the opportunity to utilize that technology to continue to improve operations throughout the bank. Other strategies include expanding the commercial deposit capabilities in the metro markets where the bank doesn't have we don't currently have a retail branch system in that kind of Vancouver to Salem, which I mentioned are kind of our higher growth markets. So expanding those commercial deposit capabilities in those metropolitan markets, as well as improving the customer experience, particularly that commercial deposit account opening, the digital onboarding process. In summary, this slide highlights the long-term value of PFLC. Our track record demonstrates our success in achieving growth in earnings and driving increased book value for our shareholders, as well as in earnings per share. We have a 50-plus year history of performance through positive and adverse times, as well as various economic cycles. We have strong reserves, solid credit quality, and an excellent core deposit franchise. Our strong capital positions and our abundant on-balance sheet liquidity allow significant flexibility to be opportunistic and to grow our business. We have an experienced management team, and with industry PE multiples below historical norms, it provides upside potential for further price appreciation. We also understand there still remains some uncertainties and with the markets very volatile right now, and that we must remain vigilant, managing costs in all areas of the bank while still investing in growth. Whatever the potential challenges, we remain rooted in our values, and I'm confident we have the right people to grow our business and to serve our customers. So with that, that concludes my presentation, and I'm happy to take questions. Okay, we have a few questions in the question box. I'm going to read the question. The first says, considering recent events, how does the bank balance the opportunity of specialization against the risk of too much concentration on the balance sheet? You know, I would say that we really have a diversified balance sheet, both on the asset side as well as the liability side. So in terms of specialization, I wouldn't say that we have really a specialization in any one sector or any particular industry. The area where we have maybe more concentration of assets than we've had typically in the bank's history is just in the amount of on-balance sheet liquidity. That's not a bad position to be in right now, frankly. We really saw deposits in the industry increase significantly between 2020 and 2021. And when you have a strong core deposit franchise like we do, and you have that much stimulus come into the market, we're going to get more than our fair share of the deposit growth. And with loan demand being soft, we really resisted the temptation to reach full yield or go into markets or niche or products that were outside of our traditional business model. You know, looking back, that has served us well from an interest rate standpoint and earnings, with the Fed moving interest rates where they were and our balance sheet being able to reprice as quickly as it has. We do anticipate as those deposits get more utilized into the economy, that those will come down, but we are still, you know, positioned very well from an asset liability perspective. Next question, what can shareholders expect in dividends and buybacks for 2023? Obviously, we can't give forward guidance on dividend expectations. What I could tell you is that the board has a policy that we, from a dividend practice, that we you know, return no more than 50% of earnings in the form of dividends, but they will be generally in line with, you know, dependent upon earnings. The bank does have a stock buyback program in place. We did put some of those buybacks on hold kind of in the second half of the year. The stock price had moved up some, and we were just being good stewards of managing our capital, uncertain about where rates were going to go in terms of the impact of the AOCI. However, you know, we have that in place, and if we deem it to be a useful tool, it is something that we will consider. Next question, is there any sector that you are cautious about? You know, great question. And we get this question asked to us a fair amount from investors and shareholders, you know, trying to get a glimpse of, you know, where we might start to see either early signs of distress, and really, you know, the areas where I believe there to be some concern are in, you know, urban commercial office space. And that's not a sector that we are really heavily let into, given that our market operates just outside of those. We are not seeing that within our portfolio. Another area that we're starting to see people maybe raise concern about is in multifamily. And we do have, you know, multifamily in our portfolio. However, in the markets where we've had some larger multifamily projects, the data there does not line up with some of the national data, where Vancouver, for example, is a perfect example where based on population growth and the lack of units and the new permits and units coming online, they still have like a 35,000 unit shortage. So again, it's a sector that we manage and monitor closely, but not seeing it in our market. And then the last one that I will say is we are seeing in terms of national trends around the consumer. So the consumer, we're seeing increase in credit card balances outstanding, increases in home equity line of credit usage, as well as savings being down. But given that the majority of our lending portfolio is on the commercial, I mean, we do some consumer lending, but it's not a big part of our portfolio. And we're starting to see within very small pockets of our consumer where maybe delinquencies will tick up in the middle of the month. But by the end of the month, however, they're back down at those industry norms. So those are the areas that I can kind of speak to that we're watching, but really not seeing yet indication in our portfolio. Maybe to that question, one of the other, not asked, but something we do get asked about would be, given the size of our portfolio that's either owner-occupied or non-owner-occupied commercial real estate, have we, conducted any stress testing in terms of cap rates, the ability to cash flow as rates rise or they reset? And we did that fairly extensively through a good portion of the portfolio last fall. Something we'll be looking to do again, maybe in the first half of this year. And we came out just fine in terms of capital, ability to cash flow, things of that nature. Go down here. Another question, do we intend on deploying the cash on the balance sheet? Yes. Obviously, I indicated in our strategic goals is to continue to grow loans. We do anticipate some line utilization to pick up in 2023 off of the pandemic lows. And we really, solid teams that have pipelines that they're actively managing to continue to provide growth opportunities for 2023. Another question, does the AOCI affect how you look at capital allocation, or is regulatory capital what you primarily look at? I would say the answer to that is both. We just conducted our safety and soundness exam with the FDIC in Q4, and they really look at the AOCI impact of capital, as does the management team here. It's not just a factor of capital; it's liquidity, it's earnings, it's what is the likelihood that you would actually have to realize the loss on the sale of the securities to generate liquidity. And so looking at our balance sheet, the makeup of our portfolio, not only the loan portfolio, but the investment portfolio and the asset mix, we aren't as overly concerned about that because of the short-term nature of the portfolio, the access to the cash portion on the balance sheet. So we do look at both. It's something that we monitor, but the AOCI piece is more of a holistic approach to both like liquidity and earnings. Okay, I don't see any other questions in the submission. So if there are no further questions, happy to turn it back over to the moderator. Thank you for joining us today.